Good morning, Bitcoiners, and welcome back to your economic calendar, where we cover the news and analysis you need to start the week off right in Bitcoin. Today is Monday, August 2nd, and as always, we have a pretty jam-packed episode. Today, we're going to start by talking about Google, who will start accepting advertisements for crypto wallets and exchanges this week, which could really move the needle for awareness in this space. We are also going to be breaking down the biggest short squeeze in Bitcoin's history, which we saw last week. And last but certainly not least, we're going to get into how the Federal Reserve is keeping mortgage rates low in the United States. So, lots to cover today. Grab your coffees. It's going to be a good one. Starting as we usually do with Bitcoin, we see that Bitcoin closed last night its second consecutive week of gains, closing the week up 12.45% at $39,839. The move was also done on increasing volume. If we see the volume that was traded last week relative to the week prior, we see that volume actually did increase on the move, which is typically seen as a good sign when more volume comes into a continuation of any particular move. And again, just to highlight, this was the highest weekly close for Bitcoin since the week of May 10th. So pretty interesting and positive price action that we are seeing from Bitcoin in the last 2 weeks. Now, this rally caught many people off guard, and a lot of this volume came from short liquidations. Now, the chart we're going to share is courtesy of Arcane Research, which was actually a really interesting and well put together report. And it basically breaks down that last week we saw $750 million worth of shorts liquidated. Actually, this was last Monday. So a week ago today, we saw $750 million worth of Bitcoin shorts get liquidated. This is the largest Bitcoin short squeeze ever recorded in one day. That's very interesting. And again, to dig a little bit deeper into that dynamic, this increased liquidation volume may have to do in part with the proliferation of USD collateral-based Bitcoin derivatives. So these are, in essence, people that are placing dollar or stablecoin collateral as they put on a Bitcoin short, whereas in the past, a lot of these derivatives were collateralized with Bitcoin itself. So when you are placing dollars as collateral for a short position, the liquidation can happen much faster than when you're placing Bitcoin as collateral for that same trade, because when the collateral is increasing in value at the same speed as your short is losing value, it makes the liquidation harder to occur. However, when you have the collateral placed in dollars and the short position is coming up against you and that collateral is basically static in value, that accelerates the speed at which these liquidations can happen. So interesting to keep that in mind. As the sort of short liquidation, Bitcoin short liquidation dynamics may change a little bit as the collateral composition that's used to put on these shorts also changes. So beyond that, this move higher has also placed, as you know, we follow the futures curves here pretty closely, and I just wanted to highlight how that's changed since last week or since this rally happened. So as you can see here from the chart behind you, which are the futures curves for Bitcoin futures across major exchanges, this move has essentially placed all of these curves in contango. So all of these contract spots options are trading higher than the current price, albeit some are showing some slow, like the steep, they're not as steep into September, but you can see that once they move on September 21st, they basically do steepen quite significantly. However, remember how we were seeing that some of these curves were showing backwardation. So future prices trading below spot for a few weeks now prior to this one. So again, very healthy to see that backwardation basically leave the curves and having them all trade at a contango. Whether it's steepening faster or slower, that's, you know, that is also impacts it. But the starting point is that most curves are showing future prices trading above spot, whether that's by $1 or whether that's by $5 or $10 or $20. The steepness also obviously tells us a lot, but the fact that they're trading above spot is already pretty positive. Again, looking elsewhere for this, for looking for potential signs of institutional participation or essentially how institutions are whether they are on and how they are participating in this market. Looking at the annualized implied basis on the 3-month curve, we see a couple of things. As you can see here, so like when you see here in the moves from around March that when spot price rallies, the spot price is that black line that you see here. When the spot price rallies, the implied premium on these futures tends to rally along with it. And what we are starting to see is that while they still rally together when the market ticks higher, the absolute terms of these rates are coming way down. And this has a lot to do with institutions taking the other side of that trade, as we discussed in previous episodes, to essentially arb the basis or clip that basis trade. So what institutions are doing when they see the futures premium go higher is they are selling that future contract and they are buying the spot Bitcoin to basically hold that Bitcoin and lock in that interest rate, that difference between the future price and the current price. So what does this tell us? What it tells us, the fact that the implied basis is actually at such a low absolute number, as we can see here, it's basically trading still sub 3% when it was trading at around 9 to 10% in October of last year. So what this is telling us is that institutions are happily taking the other side of that trade to essentially collect that interest. And they are doing that happily for a 2.5% interest or 2.5% premium, which is very interesting. 2.5% in a short time frame is basically institutions are coming in and saying we're happy to take the other side of that trade, which keeps volumes in these futures venues high and keeps, this should help volatility over time. It should make markets less volatile over time as the futures are, as market participants are able to hedge out their positions in the futures. Now, we've covered a couple of things, and we've covered how institutions are positioning themselves in this recent rally, but there is data that suggests that it's not just institutions that are participating in this current rally. So data in the chart in the back of your screen right now is data from Glassnode, and it was shared by Willy Woo, an on-chain analyst and trader, and it suggests that essentially Bitcoin holders with less than one Bitcoin in their wallets have also been accumulating significantly during the recent move. So overall, this shows that market conditions are looking pretty healthy, and Bitcoin does seem like it is preparing to make another move higher. We're going to cover a few other things in the space, around the industry. One of those things is the fact that blockchain startups and crypto blockchain and companies in this space are raising venture capital at record levels. So as you can see in the headline behind you, you see that last quarter, Bitcoin, crypto, and blockchain startups raised a total of $4.4 billion in the second quarter, despite the sort of not stellar price action that we saw. Now, in the third quarter of this year, this may very well dwarf the second quarter, the 4.4 billions in the second quarter, because in this quarter already, a month into Q3, we have already seen announcements from FTX and Fireblocks. Both of them amount to essentially over $1.2 billion in funding. So over time, and this funding, mind you, is coming from very traditional VCs. Over time, more and more of these traditional institution firms are going to get exposure to this industry, and with that comes skin in the game for the flourish, or for the benefit and for the long-term success of this industry. Now, again, connecting these two dots, we're talking about how companies are raising money at record levels. And what's also interesting this week is that Google begins accepting advertisements for crypto and Bitcoin wallets and exchanges, and that happens on Tuesday, so tomorrow, August 3rd. This should bring increased attention into the industry, or to the industry, as companies look to deploy a lot of their advertising dollars to increase awareness. So all those things are coming together, and we should see an uptick in awareness as companies look to deploy some of that that advertisement budget that they have. Now, looking outside of the price action, we saw some really positive coverage from mainstream media around Bitcoin in Nigeria over the weekend, and this came from The Guardian in the UK. And the article, which is behind your screen right now, what was really interesting to read about this article is that it highlights how Bitcoin is helping merchants and other segments of the Nigerian economy keep the businesses running in light of really unfair capital controls. Now, while this highlights how Bitcoin is creating problems for the government, it also focuses on how much Bitcoin is solving problems for real people in these markets. So it's very interesting to see these types of pieces, very encouraging. And now elsewhere, going back to the chart for a second, the elephant in the room is the potential crypto regulation that was introduced last week in the United States as part of this bipartisan infrastructure bill. We were going to be discussing how this could impact Bitcoin and crypto markets in general in our What's Ahead section later today. Now, moving over to the S&P 500, we see that it was a week of narrow trading last week for most indices, with the S&P 500 finishing down 11 base points at 4,403 points. The Nasdaq finished down basically 1% at 14,957 points, and the Dow Jones finished down 36 base points at 34,935 points. Now, the big news out of the US last week was the Fed meeting. And during the Fed meeting, we see here from the headline behind your screen, the Fed decided to hold rates near zero. And it says that the economy has gotten better even with the pandemic worries. Now, again, it will be holding the rate from 0 to 25 basis points on the benchmark rate. It also announced that it was a long way away from stopping its bond purchasing program. Now, under the current program, the Fed is spending at least $80 billion on Treasury bond purchases and $40 billion on mortgage-backed securities purchases each month. Last week, we covered how the Fed keeps interest rates in Treasury bonds low by participating in the Treasury bond market. You may be wondering, how does that translate to my mortgage rates being so low? Well, the answer to that is also the Fed. In addition to Treasury bonds, as we mentioned, the Fed also buys mortgage-backed securities, which are just bonds made up of a bunch of mortgages. This backstops that market and ensures that there will always be a liquid market to sell these mortgage bonds. This encourages banks to underwrite new mortgages. So to put things in perspective a little bit, if we assume that an average mortgage in the US is going out at around $250,000, then the Fed's $40 billion a month purchases equates to approximately 160,000 homes per month. 160,000 homes per month. Now, according to the US Department of Housing, there were 676,000 new homes sold in the US in the month of June. This means that the Fed is purchasing approximately an equivalent amount of 24% of all new mortgages underwritten in the United States each month. It's buying these in the forms of mortgage-backed securities. So that is, a quite significant share of the market itself. And do not be surprised if we start to hear about a real estate bubble soon. On a very similar thread, we covered here how investors such as Lynn Alden expressed that rents could be rising rapidly in the coming months in the United States. And I would like to show, now I'm presenting this graph behind your screen right now, which shows the speed or the rate of change of rentals across the top 100 largest cities in the United States. As you can see, like clockwork, recent data suggests that the median rent price is rising to the tune of 3% in the top 100 cities in the United States. This will impact inflation readings and should keep that number sticky above 2%. Now, elsewhere, looking at some other macro signs, we saw last week that the reserve repo facility that the Fed has topped $1 trillion last week for the first time ever. This shows how much demand there is in the markets for safe yield in money markets. The Fed's facility pays 0.05%, so 5 basis points per year, and it is overflowing. In a statement last week, the Federal Reserve also said that it would be opening up 2 more standing repo facilities and that it would make one of them available to central banks internationally, so international central banks. This is very interesting, as these repo facilities just tend to soak excess liquidity. So the Fed seems very, very focused on absorbing all of that excess liquidity to prevent rates from dropping even lower. Now, it is a quiet week in terms of the Fed, but we do get an in-depth look at the jobs market this week with the July unemployment rate. The Fed follows this rate as closely as it does inflation, and we're going to be going over the announcements in detail for this week in our What's Ahead section later today. Moving over to gold, we saw that gold saw a positive week last week, finishing up 75 basis points higher at $1,814 per ounce. Now, we've covered here that gold is inversely correlated with the real returns of treasury bonds. And we also covered how the Fed is acting in the bond markets and real inflation is running higher. Basically, we talked about how the current setup of the Fed trying to keep interest rates low and inflation actually running wild could benefit gold in the coming days. And last week gave us a picture-perfect example of that dynamic at play. So last week, there were, last week, a couple of investors highlighted that the real return of 10-year treasury bonds broke a new low last week. And that is seen in this chart here. Basically, the real return is the bond rate minus inflation, and it gives you essentially a negative real return right now. But that negative return even got more negative last week, so it broke to the south, so it broke down. And in that same time frame, gold moved higher, as evidenced by this headline from last week, which essentially just shows us that dynamic. When the real returns of these bonds drop, investors just look for other opportunities that have more positive returns, and therefore gold benefits as bonds, as people leave bonds. Gold benefits and other assets as well, such as Bitcoin, stand to benefit from that exodus. Moving over to the DeFi index, we see that it was also a positive week price-wise for the index, finishing higher by 17.44%. And looking at Ethereum, we see that it also had a great week, up 16.51% at $2,556. The big news in the DeFi space came from none other than Goldman Sachs. And Goldman Sachs essentially announced that it had filed for a DeFi or an innovative DeFi and blockchain ETF last week. Now, while the headlines sparked a conversation around the underlying investments and whether those would be considered DeFi or not, the main point here is that Goldman sees investor appetite in the concept of DeFi from their investor base, which is pretty interesting. Like, beyond the specifics, this is a pretty powerful investor appetite signal. Now, there is a lot of uncertainty around how the potential new regulatory framework in the US will affect or impact DeFi. And while volatility could be in the cards, many investors seem continuously willing to take that risk. Moving over to our Bitcoin mining difficulty commentary, we saw that Bitcoin mining difficulty actually had an increase during the last adjustment for the first time since May, when the crackdown in China started. So during last Saturday's announcement, so 2 days ago, difficulty went up by 6.03% to 14.49 terahashes. While difficulty is still well off its all-time highs, it appears that hash rate has stopped leaving the network and is now starting to come back to the network. Checking in on transaction costs, we see the mempool has held up quite well during the recent price run-up, and transaction costs have remained quite low. Really, on-chain transactions don't really get much cheaper than this, so it is a great time to be transacting on-chain. And as always, we leave you with what's ahead for the week. In this section, we want to talk a little bit about the proposed regulatory framework out of the US. So, as you may know, the US infrastructure bill that is making its way through Congress has introduced a regulatory framework for crypto and stablecoins. This is a big deal for several reasons. The main reason is that both parties want this bill to go through, which gives it a very high probability of passing in some way. Now, the proposed changes would essentially require all industry participants, from companies to protocols, to properly identify their counterparties, to report the transactions for tax purposes. To be abundantly clear, the industry should seek to clarify this framework to ensure that miners, developers, and end users retain as much privacy as possible to continue developing this community and this industry. The move to regulate this industry will certainly introduce challenges around privacy, and that has rightfully been a big focus around this conversation so far. While regulation may create challenges around privacy, it also comes with benefits to the industry and end consumers. The benefits come in way of consumer protections and a clear framework for more companies to adopt this technology and to operate at high standards, which will allow companies to offer services to a much broader audience. One of the main reasons that billions of people and trillions of dollars have not poured into this space was the lack of regulatory clarity. Having a clear framework in the largest economy in the world should be seen as a testament to the industry's success. We will do everything we can to directly or indirectly support the shaping of a fair and open regulatory framework that allows our industry to flourish. We will also continue to monitor any developments around this and share how we believe they could impact the industry and markets in general. As always, we wrap up with a summary of the upcoming economic data and earnings reports for the week. So now let's go through what we have on queue for the week. On Tuesday, we have Activision Blizzard reporting earnings, and Google starts accepting Bitcoin and crypto exchange wallet advertisements as of Tuesday, August 3rd. So this could be a big day as far as awareness for our industry. On Wednesday, the main event is the ADP unemployment report, which comes out at 8:30 a.m. Eastern. The Fed is closely monitoring the unemployment rate as a barometer for the economic recovery and look for the market to cheer a number above 628,000 unemployment claims and potentially sell off with a number lower than 628,000. Also on Wednesday, Uber and GoDaddy report earnings, and GameStop will be joining the S&P 400 Midcap Index on Wednesday. So big day for meme stock GameStop on Wednesday. Lastly, Thursday we get Dropbox and Square reporting earnings. Square earnings report may have some interesting commentary around Bitcoin, and we also get continuing and initial jobless claims at 8:30 a.m. on Thursday. Again, this feeds into this unemployment series of announcements that are coming out during this week. Now on Friday, the main attraction will be the actual unemployment report, which is due at 8:30 a.m. Eastern, and this will give us the unemployment rate in the United States. So analysts expect for that rate to come in at 5.7%. Look for markets to cheer a higher number and potentially sell off with a lower number. So big week as always, and we will continue to essentially monitor all the headlines and keep you posted on any relevant information right here through the economic calendar and through our social media at HODL with Ledin. If you don't yet have a Ledin account, I welcome you to check out ledin.io and learn how you can start earning 8.5% APY on your USDC and up to 6.1% on your Bitcoin. We also have the best rates for Bitcoin backed loans starting at 9.5% interest. Please check us out at ledin.io. Thank you, everybody. If you liked and if you liked and learned something, if you like this episode, I welcome you to hit the thumbs up and like it, share it, and subscribe it. Thank you, everybody, and see you next week.